Trader Bear back with another video. And in our last video, we taught you guys how to use the stochastic oscillator to start clearing more trades and being profitable just by using one indicator. Well, in this video, we're going to add some steroids to your trading, teaching you guys one of my favorite market reversal patterns, which are the M and W formation. Not only will you be learning the M and W formation in this video, but we're going to be pairing it with the stochastic oscillator to be able to tell and identify the best M's and W's for you to get into to make more money. So, if you guys are not already familiar, or you don't yet understand, when it comes to trading, it's not guessing at all. In fact, the markets tend to move in patterns. And when we learn to identify these patterns and get good at the patterns, well, this is where we make the majority of our money. One of my favorite patterns to follow is a pattern that you should all be very much familiar with because they're just simple letters, M's and W's. Now, before we get into the actual video, I do want to remind you that these are actual patterns and formations that we are looking for. So here's typically how they will look. You have your simple form, your extended form, and your short form. The simple form is the one that most commonly looks exactly like the letter that you're already familiar with. So if we're looking at M's, for example, you'll see the markets come up, come down, come back up to the same entry, to the same price up top, and come right back down. Your entry point is when the markets come back down and pretty much break and surpass that middle mark or the neckline of either the M or the W. That's the simple form. The extended form is when upon coming back up or down to that original point in price, you get a short extension before coming back down and breaking the M, and the short form is the opposite of the extended, whereas the market doesn't make it back up to that top price of the M, but instead reverses a little bit early and you still get the nice break of the neckline of the M, shooting straight down. So now that we understand the three forms of M's and W's, let's begin to identify these on the actual charts. Let's start with the W formation. Now, the W formation is typically a very easy formation to identify when you're looking back at the markets to try and backtest it. But as the markets are moving, the question is, how do I find or identify this formation to be able to get into it and make money? Well, it's very simple. The W formation only forms at the bottom of a market. So when trading the W, you very often want to be trading off of the lowest point of the current market. As you guys can see, where I marked up this W right here, there is no point back here that was lower than this. This is our area of support. So the markets began to come down, bounces off this level, comes back up, extends, comes all the way down, and again, as it shoots back up, we want to see it touch and break this neckline. So once the neckline was broken, we enter the trade right here at this new candle, and we would have been able to ride this up for about 2 to 3 candlesticks straight. 5, 10, 15, 20, 25 minutes of the markets pushing up, and over an hour before it even came right back down to our entry. We would have had ample time to go ahead and enter and clear this trade. This was an example of the extended W. Now let's look over to the example to the right. To the right, as you guys can see, it's a little sloppy, but we have yet another W formation. And this one is actually going to be a short form formation. But let's break it down. The markets come down to that previous level of support where it bounced off on the last W. It bounces off at the same exact price, comes back down, shoots up yet again, and as you guys can see, neckline here, breaks the neckline, opens the new candle here, and we have about 2 to 3 candlesticks to ride this up. 5, 10, 15 minutes of a straight up ride before it comes down and right here comes back to the entry about 25 minutes later. So those are 2 examples of a W. Now remember, I told you I was going to show you how to incorporate this while also using the stochastic oscillator. Well, we know the stochastic oscillator is a momentum-based indicator. And in our previous video, we talked about the stochastic cross indicating a shift in momentum. Well, whenever we're looking at the W formation, on this last reversal right here, being that we're looking to buy at the neckline, we want to see momentum shift into the buyer's market. Now, if we're looking down here, you can see clearly what did we get? The infamous stochastic cross. Right at the bottom of that reversal, the stochastic cross shooting its way to the top, showing us that momentum is pushing to the upside, till eventually it becomes what? Overbought. Now this happened here, and it also happened here on our short form W. We got the stochastic cross right here at about the 50% mark, shooting all the way up, back again, to the overbought area before making its way back down. So now that we know how to identify W's, well, let's flip it. Let's talk about the M pattern. The M pattern is pretty much exactly the same, but on the opposite side. So on the W, we were looking for W's at the bottom of the market. Why? Well, we're looking to buy when the markets are low. With the M pattern, we're looking for M's at the top of the market. And as you guys can see here, markets are pushing up. So now that we reached the top of the market here, you can clearly see how this M was formed. We have the markets pushing up, hits a nice level of resistance right here at the top, makes its way back down, creates the neck, comes back up to that same point of resistance, making this a simple formed M. And as we make our way back down to the neck, we enter on the break, and we would have been able to ride this M down for a few candlesticks, 2 to 3 as always, before coming back up to our entry. Let's give you one more M example, and that is right here. This is an extended form M, and as you can see on this example, we come up, create the new high, come back down, come back to that new high, extend a little bit out of it, we'll make our way back down to break the neckline, we enter, and boom, we catch this nice drop. Pairing this again with the stochastic cross, as you guys can see, momentum shifted right here, exactly where we wanted it to shift, and looking at the next example, we got that momentum shift right here, yet again, where we wanted it to shift. So all in all, this technique really only takes one step, finding the M's and the W's. But if you really want to master the technique, then what I would advise is getting better at identifying not only just the M's and W's, but understanding support and resistance, as well as being able to use the stochastic cross. It's a 3-step technique that tends to be very profitable. So hopefully this all made sense, and if it did, make sure you hit the like button and subscribe if you haven't already done so, because here at Trader Bear, we're here to help. I'll see you in the next video.